In today's video, I'm going to share with you a huge update on our Yieldmax, Cornerstone, Defiance, and Roundhill funds. These funds help us earn over $400,000 per year in dividends, as you can see below. If you can't see that number, just zoom in with your fingers. And our performance value shows that we're now beating the markets. We're up 19% for the year. So we've been beating the markets, but now we're up 19%. The S&P is up 12, the Nasdaq's up 11, the Dow's up 4, and the Russell's up 2. So even with margin usage, we're beating the indexes. Even after the recent 15% correction of the market, we're beating the indexes. Today, we're up 18,000 or 1.57%. But if you go to my complete view here, you can see that's 2.36%. So if you look above, you'll see that 2.36% beats the S&P. It was up 1.68. The Dow was up 1.04, and the Nasdaq was up 2.43. So we were pretty close to the Nasdaq, in between the S&P and the Nasdaq. And that's very important when we're using this margin, okay? Because when you're using margin to live financially free from your 9 to 5, you have to make sure that you're going in line with the indexes. You don't want to beat the Nasdaq too much. You want to stay in between the Nasdaq and the S&P because you don't want to fall as hard as the Nasdaq in the next market correction. So all these funds are helping us live financially free from our 9 to 5s. Once again, if you need help doing the same, email me for my e-guides at aikentod48@gmail.com. We have a huge development for our Yieldmax, Cornerstone, Roundhill, and Defiance funds, and that is that the Nasdaq QQQ finished above the 100-day moving average for us today. So we got to close again above the 100-day moving average. That is this purple line right here. So how can we take advantage of this rally in the market? Once we saw this tag of the 200-day moving average, as you can see below, we bought everything in sight that was technology related, and I made tons of updates for y'all. I've been buying Roundhill, Defiance, and Yieldmax funds. And so the question is today, how can we get the most out of this next uptrend? How can we not only mitigate our risk to the downside, because as you can see, we're against the 50-day moving average, or this blue line. So how can we not only mitigate our risk to the downside if this blue moving average fails? If we fail to get above this 50-day moving average tomorrow and we have a pullback back to, let's say, the 200-day moving average, how can we mitigate our risk to the downside while still taking advantage of the upside in case this rally has legs? Okay, what if we make it past the 50 and we go back to 500 or old highs? We're still about 8% away from the old highs. So it begs the question, is this market rally over? Does it have legs, or is this a bear trap? A lot of people are saying this is a dead cat bounce, but I disagree, because if you go to the S&P, you'll see that we finished above the 50 today, and that's also very positive. That's a huge development for our Yieldmax, Cornerstone, and Defiance funds. And today we're up 18,000. How did we get all of that performance today? How did we get in line with the Nasdaq? We finished just below the Nasdaq and we blew away the S&P. How did we do that with funds that supposedly erode? Okay, if you go to a chart of, let's say, CRF, you'll see that it was up 1% today, 1.3%. We want best of both worlds. We want days gains and dividends. So the question is, what can we buy more of right now to take advantage of this rally? So I want to buy some more Cornerstone, but I can't get that over 400,000 in my portfolio because you don't want to have too much exposure to closed-end funds. I mean, closed-end funds fell heavy in October of last year, and so we saw what that can do to our portfolios. Closed-end funds are great investments, but still, you don't want to have too much closed-end fund exposure. There's CRF there, 5-star fund, and it goes upward, left to right on its chart, as you can see by the Morningstar chart. So I don't want to buy more Cornerstone, even though it had a huge bounce back, even though it has a 20% dividend, 20% premiums that it averages per year, and a special drip to where if you buy it up here, it's dripping down here at the bottom for free money every month. No, I don't want to buy more Cornerstone. If you're in my live members videos, you'll see that I traded some Cornerstone today. I sold some Cornerstone into the strength because I was trying to rebalance that back to 400,000 to keep my discipline, to keep my position sizes at 400,000. Now, if you look at Cornerstone, it moves sideways to down on its 10-year chart. But again, on the Morningstar chart, it moves upward, left to right. That's because you have to factor back in dividends, drips, and rights offerings for Cornerstone. If you need help timing Cornerstone around its rights offerings, that's in my volume 4 e-guide. The key with Cornerstone is getting these premiums each day. These, today we're up 1% and we get the 20% dividend. So we get these premiums in Cornerstone and the 20% dividend and the special drip, but you have to time it between these channels. When you buy my e-guides, you get free access to Discord for life, where we alert you of the Cornerstone rights offering announcement. So that's how we're up so much today. It was from Cornerstone. That was 5,000 of our gains today. And then Roundhill was another big chunk of our gains. All right, Roundhill, we've been pounding the table on Roundhill recently, and the reason why is because it has upward left to right movement on its chart. As you can see here on a 1-year chart, it moves upward left to right a little bit, kind of like Cornerstone, but it gives you a huge dividend. Now, the key with QDTE, why don't I put more in QDTE? If it has a bigger dividend than Cornerstone and it moves upward left to right on its chart some, why not buy more QDTE? Well, it has 50% maintenance. That's the reason why. So if you're a follower of my channel, you know that for every $1 you put in your account, you get $4 of purchasing power. I'm just using a fraction of this 1 million in purchasing power to get ahead. And this 400K doesn't show up on credit checks to banks, and I can click sell at any time and this debt is gone. When the market crashed recently, we were down 15%. My margin debt didn't grow because of the losses. The only reason why it grew is because I took advantage of the dip. When we got that 200-day tag on the QQQ index, when we got that tag of the black line there, I was immediately alerting you all, especially my members again who follow my live portfolio service. I was there with them early in the morning, doing buys that day. We're going through our buys and sells. In case you don't know, I hedge my portfolio with options, all right, and they're up again over 1,000%. For those of you who bought my options, the strike prices that we had, they worked really well for us and they kept our available withdrawal high. All right, that's the key to living the FIRE lifestyle, is keeping high available withdrawal, and high maintenance takes that away. And that's the problem with QDTE. All right, so you got to have some insurance on if you use a lot of margin like me, or if you invest in a lot of tech like me, that offsets the volatility in your account in a given crash. So if you need help insuring your portfolio like I do, that's in my volume 5 e-guide. And if you need help understanding maintenance, okay, that's in my volume 3 e-guide. So QDTE, you have to understand the maintenance here, 50%. That sucks up half of my equity here. Now you can go to other brokers that have lower maintenance, but they might not have the special drip for Cornerstone. I have to say this because a lot of people will comment in my video after this. They'll say, well, you can go to Robinhood or Interactive Brokers and they'll have lower maintenance for QDTE and XDTE. That's true, but they don't have Cornerstone or the special drip. You want Cornerstone because it has 30% maintenance, as you can see here, 30% maintenance. It moves upward left to right on its chart between its rights offerings, and it drips the dividend, the 21% dividend, down at the NAV. So you get the 20% dividend and you get days gains to participate with the up market. Why wouldn't you want Cornerstone as an addition to your portfolio, especially with the free drip again every month? So you have to have Cornerstone for the special drip and you need the low maintenance. If you go over to Robinhood or Interactive Brokers for that lower maintenance, you're going to face a lot more volatility in your account because some of these funds like Yieldmax can fall harder than the indexes on a down day. So you don't want to just pile in to Roundhill or Yieldmax just because they have lower maintenance at another brokerage, again, because they could fall harder in a crash. You don't want to see your performance take a big hit. So Cornerstone, that was 5,000 of our gains today. QDTE, that was another big chunk of our gains today, but I can't put too much in QDTE because of that high maintenance. Yieldmax, that's also 50% maintenance. So even with the 30% dividend, I like it, but it's not fully diversified and it has 50% maintenance. So once again, go to another broker that has lower maintenance, but don't just pile into these funds just because they have lower maintenance. They have a lot of volatility that can really hurt you in a down market. The reason why we're outperforming the way that we are, we're up still 19% for the year now, is because we have a lot of other names in the portfolio to shield our volatility. We have a lot of staples. I have about 100 grand in staples names. We have Cornerstone. We have a lot of other closed-end funds that help shield our account from unwanted volatility. So it takes a total approach to outperform the market with this margin debt. Okay, you have to have some low beta names on and some high beta names. Okay, you have to have staples. Cornerstone held up really well during the correction, and so that's kind of low beta in my opinion. So is Defiance. Defiance held up really well during the recent correction. Defiance went down less than the market on down days, and that's why I like Defiance. It also has 30% maintenance. Defiance is still doing well. If you see its chart here on Morningstar, you can see that it's actually outperforming the index. So even though people don't like Defiance, there's the truth of Defiance there. It moves upward left to right on its Morningstar chart, whereas on E-Trade, it moves sideways to down. So I'm used to this complaint. People always complain about Cornerstone and Defiance. They can't stand the decay in those funds. But if you just take a 20% dividend like you have with Cornerstone, you multiply that times 5 years, you double in 5 years. Now, I know that the real returns for Defiance are something more like 10% or 20% for the year. But again, I'll take 10 or 20% for the year with Defiance. As long as we're getting that qualifying income from those really high dividends in Defiance, then I'm living free from my 9 to 5. So you use these dividends to qualify to banks for loans. And that's why it's really important to have have Defiance. They have really high dividends. They're qualifying for more loans to banks for me, and they're still giving me a nice return, a 10 to 20% return. Okay, so also in our sold options section here, you can see that we're up a few thousand in these options. Yes, I sell options on these asset classes to lower my margin. So I collected about 50,000 in premiums from selling these options. They lower my risk, they lower my cost basis, and they lower my margin. So when they lower my margin, they lower my margin interest. So I don't really care about my margin interest because it's around 6%. Many of my clients who bought my e-guides negotiated their interest down as well. I send you the script when you buy my e-guides. So you can get your margin interest down. That's not really a problem, especially with the dividend funds that we have. I mean, they give us such a high dividend. Who really cares about our margin interest? But when you have this amount of margin on, you want to try to pay down your interest as much as you can. So I sell these options to, again, lower my risk and lower my margin. Okay, selling options is the least risky way to play options. Everyone thinks selling options is risky. No, buying options is risky. Selling options is not risky. It's kind of like buying dividend funds. Buying dividend funds aren't risky to me because eventually the dividends cash flow all your losses. When you sell options, it's the same thing. You're just selling time, and eventually your premiums cash flow all of your losses. So I'm just waiting till expiration in these options. BidX, I'll collect this 3,100 times 7 contracts, so that's about 20,000, and we can just settle above my cost basis, which is in the teens. All right, if you take the strike price 50 minus the premiums, my true cost basis is in the teens. So I'm just waiting till expiration to collect this full 20 grand. If we go lower, then I get assigned in BidX. If we go to the teens, which is a huge drop from current levels, then I get assigned at the lows, and then we really make a lot of money on the upside. Okay, so that's how I get more performances with these sold options. If you need help selling leap options like I do, that's in my volume 6 e-guide. So it takes a total approach to outperform the market. All right, we're outperforming the market. We're up 19% for the year. You know, getting these dividends of over 400,000 per year and these days gains of over 18,000. There's an art to doing it. And now that the market has gotten above the 50-day moving average and the 100-day moving average, again, the S&P got above the 50-day moving average and the NASDAQ got above the 100-day moving average today. So with this development, this is a huge development. You have to have this long exposure on with the funds that I've mentioned, but I also protect myself with those put options just in case we have some kind of reversal. Again, I don't anticipate a reversal to the downside. I feel like the recent correction was an absolute gift. There was no reason for it to fall like that. When the VIX spiked to 60, like you saw it do here, that was completely irrational in my opinion, all because of a Japan interest rate raise. I mean, that's not going to affect our markets that much. So especially when a lot of our tech names don't rely on interest rates anymore for their cash flow models. They make so much reoccurring revenue now with their software as a service models that interest rates or a slowdown in the economy won't really affect the earnings of these tech companies because we always use our phone. Our phone is a way of life. The internet and the cloud is a way of life. So any of these dips should be bought. We bought heavily when we hit the 200-day moving average. Now we're above the 100. This is a huge development. So we still have 8% upside before we reach old highs. Are we going higher or are we going lower? We never know. We can only be ready for both directions. We can only watch our maintenance in these funds and our available withdrawal and our insurance. As long as our available withdrawal is high, we can still withstand over 20% corrections from here and withdraw freely from our brokerage account. I can swipe my E-Trade card and go wherever I want in this world. Even with all this margin debt, I can still buy whatever I want with my E-Trade card. I just withdraw out of my account out of this available withdrawal. So the key is watching your maintenance in these Roundhill and Yieldmax funds and watching your insurance. Okay, I keep the insurance on and I keep my maintenance low. All right, and that way I can live off this margin. This margin will be paid back in less than 1 year because of my dividends. My dividends of over 400,000 per year will pay back this margin debt in less than 1 year. All right, so if you need more help doing what I'm doing, email me for my e-guides at aikentod48@gmail.com. When you buy my e-guides, you get free access to Discord for life and you get my phone number for life. So just keep this in mind. Your likes that you've been giving me recently have really been helping me get more views on these videos and push my videos out to more audiences. So please keep those coming. All right, and I'll talk to you soon, everyone. Thanks.